Price drops hard, but the bounce is not free. The session forms between weekly pressure and old US memory. Before any trade, the higher time frame comes first. Monthly chart first. Weekly chart second. Daily chart third. Then the 1-hour chart. Do not reverse that order. The 1-hour candle can move fast. But the weekly chart decides where that fast move becomes dangerous. This week has already followed the larger scenario. Price keeps falling into meaningful lower areas. April 1st weekly lower memory. March 1st weekly lower memory. February 1st weekly lower memory. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. These levels are not background. They are the field. When price falls into them, the trader feels the bounce coming. The drop looks stretched. The red candles look exhausted. You want the long. Then price drops again. That is the trap. A large drop does not create a long. A weekly level does not create a long. A wick does not create a long. Price must hold. Price must reclaim. Price must build distance. Now watch June 3rd Asia session. The session forms exactly between April 2nd US session lower boundary and weekly 0.33. That location matters. It is not floating in open space. It sits between old 1-hour memory and higher time frame pressure. The session basis box is the battlefield. It sits above the weekly 0.33 area. It sits below April 2nd US lower memory. Price is already squeezed. Then price moves lower. It breaks below February 24th US session lower boundary. It does not just touch it. It leaves it. The move reaches lower. Then price bounces. It tests June 3rd Asia session lower boundary. That test matters. Broken session memory comes back into play. If price can reclaim the lower boundary and hold above it, the short weakens. If price reaches the lower boundary and cannot stay above it, the short remains alive. Price reaches. It reacts. It cannot take control. The bounce stalls. Distance becomes shorter. Reaction comes back faster. Then price drops again. It breaks below February 24th US session lower boundary again. Now the first trade has structure. We do not start with entry. We start with a stop. A trade without a stop line is only emotion. Short stop line. June 3rd Asia session upper boundary. Short entry line. June 3rd Asia session lower boundary. Short target line. February 24th US session lower boundary. Risk-reward ratio 1.72. The entry sits at June 3rd Asia session lower boundary. Why there? Because the session formed between April 2nd US lower memory and weekly 0.33. The lower boundary becomes the line where sellers must keep control. If price breaks below it and cannot reclaim it, the session accepts lower movement. That is the short entry. Not the first red candle. Not the fear. Not the speed. The short begins only after the lower boundary fails. The stop sits at June 3rd Asia session upper boundary. Why there? Because if price returns through the entire session box and reaches the upper boundary, the short has lost control. The failed lower boundary no longer matters. The session has returned to the top side. The downside idea is damaged, so the stop belongs there. Not closer because we want bigger size. Not deeper because we are afraid. At the line where the idea breaks. The target sits at February 24th U.S. session lower boundary. Why there? Because price already broke that old memory. Then it returned. Then it broke again. That line becomes the first clean downside completion. If sellers control the session lower boundary, the first target is the next old memory below. The short pays there. But that is not the end of the story. After the target, price moves into deeper extension. Now the second trade appears. This is not a revenge long. This is not buying because price fell a lot. This is a reaction long only if the deep extension holds. Long entry line. February 24th U.S. session lower boundary negative 200% area. Long stop line. February 24th U.S. session lower boundary negative 300% area. Long target line. February 24th U.S. session box upper boundary. Trailing target. June 3rd Asia session lower boundary. Risk-reward ratio 2.64. The long entry sits at the negative 200% area. Why there? Because price has already stretched below February 24th U.S. lower memory. It is no longer a normal pullback. It is an extension move. At that depth, the question changes. Can sellers keep pressing? Or does price start reacting from extreme lower memory? The entry does not come from guessing the bottom. It comes from price reaching the extension area and failing to continue lower. The stop sits at the negative 300% area. Why there? Because if price breaks deeper through that area, the reaction trade is wrong. The extension has not finished. Sellers are still in control. So the stop must sit below the reaction zone. The target sits at February 24th U.S. session upper boundary. Why there? Because the reaction long is trading a return back into the February 24th U.S. memory box. If price reclaims the lower extension, the upper boundary becomes the clean recovery target. The trailing target then reaches June 3rd Asia session lower boundary. Why there? Because that was the broken session memory. A recovery into that line shows the reaction has gained more distance, but the trail only works after price earns movement. Do not trail because you want more. Trail because price has already paid. When the target moves, the stop must move too. A target that moves without a stop is just hope. But the stop cannot be too tight. If normal reaction touches it, the trail kills the trade. If the stop stays too far away, the trail protects nothing. A useful trailing interval needs space. About 0.5 risk-reward unit or more. Less than that becomes noise. More than that gives the trade room. Now manage size. An aggressive trader may use tighter stops, smaller stop distance, larger position size. Sometimes that works. Price never touches the stop. The trade pays, but the cost is real. Normal reaction can hit the stop. The idea can stay correct. The position can disappear. A conservative trader gives the structure more room. The stop is not too tight. The position size becomes smaller. The trade survives more noise. But if the wider stop destroys the ratio, the correct answer is no trade. Now, partial profit. If the first target reacts fast, protect more. A conservative trader can take 60% first and leave 40% for continuation. If price keeps distance and pullbacks stay shallow, an aggressive trader can leave more open. 40% first, 60% for continuation. If there are two stages, a conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But percentages do not create the trade. They only manage structure. June 3rd Asia gives two lessons. The first short starts after the lower boundary fails. The reaction long starts only after deep extension holds. Both trades need stop first. Both trades need entry second. Both trades need target third. Price reaches. It reacts. It holds or fails. Then the trade earns execution. Price keeps moving. But the next session gives no clean trade. The larger pressure is still active. The weekly chart still matters. Price is falling into the same meaningful zones. April weekly lower memory. March weekly lower memory. February weekly lower memory. Weekly 0.33. Weekly 0.25. February 5th key low. Trendline pressure. The 1-hour chart cannot ignore that field. If today feels confusing, go back to the weekly chart. The weekly chart explains why price keeps dropping. It also explains why every bounce feels dangerous. Now watch June 4th U.S. session. June 4th U.S. session forms inside February 24th U.S. session box, but it does not match it quietly. It expands about 150%. It overlaps. That matters. A 150% expansion changes execution. The box is wide. The reaction can travel farther. Support and resistance become wider. The stop becomes harder. The target becomes harder. A wide box can give movement, but it can also destroy the risk-reward. June 4th U.S. session then continues inside its own basis box. It does not leave cleanly. It moves inside. It rotates. It tests. It returns. That is the key. The market is moving, but the trade is not clean yet. Now apply the same rule. Stop first. Entry second. Target third. Check the long. Possible long stop lines. June 4th U.S. session lower boundary. June 4th U.S. session negative 200% area. February 5th key low. These are possible stops, but they are deep. They ask too much from the account. They make the position smaller. They can reduce the reward. Possible long entry lines. June 4th U.S. session lower boundary. June 4th U.S. session midpoint. These lines can make sense if price holds the lower side and starts to reclaim the box. Possible long target lines. June 4th U.S. session upper boundary. Weekly 0.33. June 3rd Asia session lower boundary. April 2nd U.S. session lower boundary. June 3rd Asia session upper boundary. These are possible targets. But the problem appears again. When stop, entry, and target are combined, the risk-reward does not reach 1.5 cleanly. The stop is too deep. The target is too close. The box is too wide. The long does not deserve entry. The price can bounce without us. The account does not need that risk. Now check the short. Possible short stop lines. June 4th U.S. session upper boundary. Weekly 0.33. June 3rd Asia session lower boundary. April 2nd U.S. session lower boundary. June 3rd Asia session upper boundary. These lines can protect a short, but many of them sit above the current structure. They make the stop wide. Possible short entry lines. June 4th U.S. session upper boundary. June 4th U.S. session midpoint. These lines can make sense if price fails at the top side. Possible short target lines. June 4th U.S. session lower boundary. June 4th U.S. session negative 200% area. February 5th key low. But there is a condition. The deeper targets only matter after price tests the June 4th lower boundary. Without that lower test, those targets are not earned. If the target requires a move that price has not even started to prove, the trade becomes early. Again, when stop, entry, and target are combined, the risk-reward does not reach 1.5 cleanly. So the short is skipped too. That is the main decision. Long fails the ratio. Short fails the ratio. No trade. Not because the chart is dead. The chart is not dead. It moves. It rotates. It tests. It tempts. But the risk does not deserve the reward. This is where many traders lose money. They see the large move from the previous session. They think the next trade must be obvious. They see the bounce. They want the long. They see the rejection. They want the short. The market gives both feelings. But the structure gives neither trade. That is the trap. A wide, expanded session box can make every line look important. But when every stop becomes deep, the account has no clean advantage. You do not trade because a line exists. You trade because the line gives risk and reward. If the ratio is weak, the trade is weak. If the stop is too deep, the trade is weak. If the target is not earned, the trade is weak. Now think about aggressive execution. An aggressive trader may tighten the stop. That improves the visible ratio. It allows larger size. Sometimes the tight stop survives. The trade pays. But in this kind of wide overlapping box, reaction can be violent. A tight stop can be touched by normal rotation. Then price can move toward the target without you. That is not clean execution. That is guessing with a small stop. A conservative trader has a different answer. Use the structural stop, reduce size, or skip. Here, the better answer is skip, because even the structural combinations do not pay enough. That is the point. Conservative trading is not always wider stop and smaller size. Sometimes conservative trading is no trade. The account stays ready. The method stays clean. The next session can give a better line. Now trailing does not apply. Why? Because there is no entry. No entry means no trailing. Do not create trailing rules for a trade that should not exist. But the lesson still matters. When a future trade appears, the trail needs about 0.5 risk-reward unit, or more of additional distance. The target can move only after price earns it. The stop must move with it. The stop cannot be too tight. The target cannot become hope. Partial profit only manages a valid trade. It does not fix a bad one. If there is no clean entry, there is no partial profit plan. There is only waiting. Now connect June 4th US to June 3rd Asia. June 3rd Asia gave action. Short first. Reaction, long second. Both had clear structure. June 4th US gives rotation. Long idea appears. Short idea appears. Both fail the risk-reward filter. So the method changes. Earlier, execute. Now wait. That is real trading. The trader does not need to act every day. The trader needs to act when the structure pays. June 4th US forms inside February 24th US memory. It expands 150%. It moves inside the box. It does not give clean ratio. So the official action is no trade. If you cannot understand the movement, go back to the higher time frame, monthly, weekly, daily, especially weekly. The weekly chart showed these lower zones before the 1-hour chart arrived. The 1-hour chart shows the fight. The weekly chart shows the field. Without the weekly chart, Every bounce looks like a bottom. Every drop looks too late. Every wick looks like a signal. With the weekly chart, you wait. You know the market is still inside a larger downside path. You still do not chase. You still need stop, entry, and target. June 4th US does not give them cleanly. So the account waits. Price reaches. It reacts. It rotates. But if risk-reward fails, there is no trade.